So, a quick introduction. Good morning, everyone. Roopal Kanabar. I am Strategic Finance Advisor to the Landscape Finance Lab. The lab supports practitioners and investors to launch, structure, and finance deals at a landscape scale. So, as a personal introduction, I'm a banker by training, so hopefully do understand the language that many of you speak in the room. And I have the pleasure of moderating the session today. How are we going to make capital flow to landscapes and do all the right things by the world? So, Edith, maybe we can start off with you. Integrity is a new organization. There's lots going on. You guys are really filling in a gap in the market. It's super exciting. I'm sure the audience would love to hear a little bit more.
Thanks a lot. Thanks, Roops. Pleasure to be here. Thanks for sticking around before lunch. So my name is Edith Kiss. I'm co-founder and chief commercial officer at Integrity Global Partners. By way of maybe a bit of background, so I have spent 17 years on the carbon market, starting on the EU ETS, on the compliance side, on the trading side, then worked on the origination and structured finance and portfolio management under the Kyoto Protocol CDM mechanism, which is more on the project finance side, and then spent 9 years on the impact investing side, working on investments, business development, and really start through that engaging with the voluntary carbon market, where we used carbon finance as part of the impact investment thesis. And then I also spent a year last year on the project development side, so I've seen all the various segments of the value chain of carbon and environmental markets, and could experience firsthand actually where the gaps are, and really come to see and where that the this early stage risk capital and early stage financing gap is really massive. And also what we heard yesterday from the institutional panel, not just the financing gap, but also the capacity, the local implementation capabilities and expertise and project development side. So with Integrity Global Partners, our funding mission with our team, and we have also Sherry, who you have seen on the panels yesterday, really came together with a funding mission to address these challenges, these gaps, in particular these two gaps. One is the early stage capital, and the other one is the capabilities, the capacity for developed pipeline, which is critical in our view for unlocking the institutional space, which in itself is critical to scale the market, because we can't scale the market just on corporates and corporate capital. So where does the name come from? Integrity, obviously, we set ourselves a big challenge, a high ambition. Again, around integrity, maybe just to explain also how we have seen the market. So I worked with the Althea Climate Fund, and again, we came into this space in 2013, one of the first, I guess, funds and institutions to work on voluntary carbon market, utilizing, again, carbon credits as a tool, not as an aim, but as a tool for impact investing, for transforming the landscapes, sustainable landscapes. And we came to this with a very deliberately careful approach. So we designed an ESG policy based on the best practice back then from DFIs, utilizing, for example, IFC performance standards and a really robust risk management framework. We have developed impact KPIs back before SDGs were SDGs. So again, really trying to come in, because we understood how risky it is reputationally, all the challenges which we see unfortunately materialize today. And then what happened is, around 2018-19, when the market exploded, there has been a lot of obviously new actors come in the space, and obviously the corporates stepped up, which is great, but the institutional money, as we heard, didn't follow. So what we have seen is obviously a quite natural way of evolution when the market grows, is that you have a rush to the lowest common denominator. And so that's very risky, and there are some obviously loopholes in the standards, as we know. And on the other side, we also heard that there has been so much technological development, such an exponential growth, that the standards just couldn't keep up with it. But luckily, we have enough evidence, enough lessons from these first pilots, from these first projects, and we are at an inflection point. We truly believe that it's a pivotal moment to push the market to the right side. There is still a bit of resistance because uncertainty, people don't like uncertainty. But on our side, we really want to challenge that and push the bar high. raise the minimum bar, but also challenge ourselves to test and try how we can go to really at the forefront of this transformation, of this push to integrity. Because again, for engaging institutional capital, the bar is really high, right? We discussed that again. We heard about it yesterday. It's not the same bar as for trading carbon credits. It is much more complex. So that's on the integrity piece. And again, we have our high integrity framework. It's still under development, and very happy to engage with anybody who is willing to push this with us. And obviously, yeah, we are not alone. We have a lot of aligned partners on that. So yeah, that's on the integrity side. Maybe just before I leave it to Karin to explain a bit on our model. So on the missing middle, so on the early stage capital, everybody heard about the missing middle. I have heard that word for probably last 10 years. Investors say there are no projects say there is no capital. Obviously, that's true. Maybe, again, to understand where the market is coming from. So this conservation, and so we're talking about, again, the dark green side, so the conservation, restoration, nature-based solutions, comes from a development background. So it came from a lot of ODA grants and philanthropic money. That's how projects started. And when the market has, again, gone through exponential growth, all this kind of more like philanthropic or type of capital is drying up, because they say, well, the market is now financeable, right? Why that capital is not additional. So there is obviously the additional is very key for donors and philanthropists. So what we have seen is that more recently, that early stage funding is coming from a much more commercial and high return seeking sources, opportunistic sources. Again, corporates have stepped up. They moved up on the value chain. They're going more upstream. Hedge funds are coming in. We have seen carbon streaming companies, so innovation, a lot of innovation. The problem is that obviously if you take high risk, you need very high return. And this high return seeking capital is sometimes very challenging for this sector in our views, because if you do that too early, when you don't even know what's the carbon rights, you don't even know what your project looks like, you might compromise too early on your future revenue share and benefit share, and there you go, back to integrity. So that's one of the other problems today on the market, this fair revenue share, how we create a model that actually is long-term sustainable and doesn't just favor a few few traders or opportunistic more like short-term enterprises that come in for more like for the gold rush, a new gold rush, the carbon rush. So we want to really challenge this, and that's why we came up with a solution where we're focusing on institutional investors and trying to see what is the biggest bottlenecks there. And again, we heard one of them is the pipeline and the capabilities that they're not necessarily able to have in-house teams, like large in-house teams with the multidisciplinary nature that is required for this very complex asset class or assets. And so we call these development companies, and Karin will explain what that entails. But the idea is that we want to create these solutions dedicated to investors. It's not a project developer. We're not trying to be a project developer. We want to work with project developer and help them to grow as well, and work with the investors who should look at these costs, who should look at this early stage capital as a cost, as an upfront cost, rather than as an investment that will catalyze them or help them to build those pipelines, which in turn will help with the fundraising, shorten the fundraising cycle, and the deployment cycle, which is also a very big J-curve at the moment, and it's very costly for asset managers. So that's kind of the idea, and I will leave it to Karin to go into the details of that.
Yeah, thanks. That's super interesting. So hopefully it's really clarified what gap they're filling in the market, and it's very, very unique. And we have a lot of institutional investors in the room today, and Karin, I was wondering if you could just maybe give a bit of background about yourself, and what does the model mean in practice? How can people in the room here today participate in this amazing model you've created?
Fantastic. Thank you so much, and thanks for inviting us to this space. It's delightful to be here. This is really an amazing moment for me. So I started my career about 30 years ago doing smallholder farming and sustainable logging in the Amazon, in the Brazilian Amazon, much like an environmentalist would, and realized that I needed to learn a different language. I spoke Spanish and Portuguese, but I needed to learn finance. So I went to business school. and I joined a real estate finance company. I spent 10 years doing affordable housing finance, municipal bonds, tax financing in the United States. I did public and private debt and equity and structured instruments in the US, and then took some of the first emerging markets, workforce housing funds, into Africa with DFIs and pension fund capital. We also launched the very first solar tax equity funds in the US, so we were part of the team in 2006 that structured the first solar deals in the US and tried to convince institutional investors that actually the sun would continue to come out and that they would not lose their jobs if they took this to their investment committee. And what we ended up doing was taking a lot of the boring, regular, old-fashioned rules that we were doing in underwriting our real estate and figuring out which parts of it we could extract and replicate and transform into the renewable energy space, and enabled it to scale and replicate and became a huge industry and a huge process, such that that initial team that we were part of then seeded a lot of the renewables companies in the US and globally after that. Around about 2010, 2012, we started to see this huge influx of investors who wanted to come into that space, and they were saying, we cannot find good quality deals. The developers don't quite know how to pull those together. The capital was standing on the sidelines, and we needed to see developers come together, and we needed development companies and sophisticated pre-development companies that were able to organize projects. Fast forward to today, and joining with Sherry and Edit and others, we see we're in very much the same space in this area now. In the natural capital space, we need at least $800 million a year, billion dollars with a B, a year, deployed into this space to stand any increment of a chance of addressing climate change. Right now, we're at probably about a third of that being deployed, and the private markets are only putting in less than 20% of that number. So we're not going to get there if we can't figure out how to bring private markets into this space. And to be able to tap into institutional capital means to take these things that you've been hearing about for the last 2 days that are a little complex and figure out how to make them extremely boring and extremely streamlined and looking and feeling in ways that at least are talking about the same language that you would be used to seeing in an institutional investing space. And so that's very much what we are trying to approach in creating what we're calling our development company strategy. We recognize and have talked to a lot of investors that are ready to, wanting to deploy, can organize up hundreds of millions, if not billions of dollars to deploy into the space, are looking for qualified projects that have high integrity, that are investable, ready to invest in, but are not finding those. And so through the development company, what we're basically doing is a small pool of revolving capital. We have a sizable pipeline of projects, and we work with developers in country. They are the on-the-ground people who know the communities and know what's going on there. What we have is a very experienced small group of professionals who have done this for many years, as you've been hearing. And really what we do is go in and do a SWOT approach of what's the gap analysis in this project, applying a 5-pillar framework that I've developed over the last 20 years, it's a long time, 20 years, where we look at the kind of fundamentals of what would be needed in these projects, looking at the people element of what's going on at the community level, who are the people who are involved in the projects, the land, the titling aspects of it, the technical intervention that's required, the implementation expertise to make these happen, and the government and permitting and all of the aspects going in with the government on that, and then wrapping all of that up with the data analytics, the financial analytics, the cost and the revenue streams, and maybe there would be multiple revenue streams, and then the impact metrics. That enables us to develop and deliver a robust investment offering memo, basically, and data room that's going to give you basically an investable project. We're not doing the due diligence. The investor still has to apply it in a methodology that's going to work for your investment committee, but really packaging up projects that might be at a lot of different stages along the way. and then delivering them into SPVs. In addition, we stay in the project, so we're very much like a technical O&M provider throughout the life of the project, ensuring that there is implementation, a surety throughout the project. We'll have our own people on the ground providing continuity of financial capacity building, the carbon capacity building, the implementation capacity building, so that we're underwriting and structuring up front. We're making sure that it's going to actually be delivered throughout the long term. What's really interesting about the model is that it solves this problem of where does the pipeline come from and how do we get projects that are ready to go, that are a little bit closer to ready to go. It may still take a while to do implementation, but now we've addressed the issue that Edith was mentioning, which is you can't even value the project if we don't know what the revenue streams are at the time when people are bringing in kind of apples and rhinoceroses and different things and figuring out what is this project. And so through that organization of the project, we're able to get to something that's much easier and clearer to underwrite. Risks have been identified. Haven't necessarily all been mitigated, but we've at least identified where those risks are and then the pathways that we can take to mitigate some of those risks. And so, I think that and the other thing is, it doesn't take a huge amount of time and a huge amount of money. We're saying generally we would stay in projects during that early stage of 12, 18, 24 months. Some of those projects might need some additional proof of concept funding, but really this is flexible capital that's able to kind of organize the projects, deliver them into the SPVs, and then at that point be ready to start deploying much larger pools. So that's the concept.
Yes, that is very interesting, and I think you've given us a really good flavor of how you develop pipeline. But there's a number of different investors in the room who can all participate in different parts of the capital structure, and blended finance is a key buzzword. We need to catalyze the flow of capital. What's your view on how blended finance could actually make capital flow to the sector, and more specifically through Integrity's model?
Thanks for that. Yeah. I think there are a number of ways where we would need to see blended finance come in and really be able to leverage it. Within the development company itself, as I've mentioned, it is in many ways a revolving facility, a working capital facility. There is an opportunity to come in both through debt and equity, but also through grants and for service fees. And the reason why that's so critical is that we can, as we've seen, a lot of projects will have some multiple revenue streams, and we need to be able to test out and prove out methodologies to add additional revenue streams. So in some cases, we're looking at projects that if we can rationalize and systematize the biodiversity credits, for example, as an additional layer of revenues within a project, that might be an important way to apply blended finance into a project to just do a little bit more product development on that front. In another capacity, I mentioned we are developing developers. And so there are developers all over the world, and we need to build that funnel of capacity globally so that more and more and more of these projects can happen. We need to have the patient capital to be able to work with them. Integrity is a for-profit corporation. We are not a philanthropy, but we want to be able to partner with the right organizations to make sure that we're really transferring this knowledge and building a full ecosystem, ideally to replace ourselves at some point. We can move on and go to the next frontier. And so I think that blended finance is needed both within the development company and then in the future in these SPVs, there are any number of places where it might be needed to enhance the returns or enhance the opportunity to make a greater impact at the landscape level.
No, that's really good to hear. So I think we've talked about your project pipeline, we've talked about the capital structure. What you're trying to do is immense. How are you going to do this? What are the steps? I mean, it's such a massive undertaking. How are you going to do this?
Fair question. So yes, we are a small team, but we have deliberately designed a lean model. We are trying to build a 100-people company and raise a lot of capital. So what we think is, again, we need an ecosystem. For this market to scale, we need an ecosystem of like-minded players and throughout the whole value chain. So we're trying to address, again, the upstream part. So we designed what we call a hub model, where we work with the best select partners we find in each area. So we're looking at, again, holistically according to our high integrity framework, whether it's carbon technical, whether it's biodiversity technical, MRV. We have already partnered with space intelligence on the geospatial side, soil carbon. So looking at all the aspects and all the ingredients for the cookbook, or to make this happen, because this is, nobody can do this alone, and developing it in-house, again, doesn't make any sense. So that is why we're actually very pleased that we're announcing today the addition, a newest partner to this hub, which is the Landscape Finance Lab, announced today, because to implement the 4 return framework, which you heard yesterday Paul explaining, which we think is crucial. So again, in the quest to see how can we challenge the current standards or the current approach and go forward or further, we believe that, again, the landscape approach is critical, especially for, again, institutional investors, where we need to go beyond pure just environmental assets or timber or crops, but we have to have a holistic framework. And we believe this is very relevant for maybe not all projects, but definitely large-scale projects and also jurisdictionals, which we, again, discussed a lot today, how we're going to get this massive undertaking with jurisdictions. So very pleased to join forces and look forward to piloting the first landscapes very soon.
Yeah, absolutely. So we're super excited at the lab to join forces. We believe that our skill sets are very complementary. We can help each other with pipeline. We both have a global focus. And for everyone here, we know that investment in sustainable landscapes is key. Project financing often kicks the ecosystem out of whack. We need to look at everything at a landscape level. If we're going and financing water, what does that mean for the soil? Climate change, biodiversity, that's all interlinked, right? And in addition to that, you've got investing in sustainable landscapes actually improves livelihoods. It creates jobs. It really works with the indigenous communities on the ground, which I just think is so key. And to that end, I'm super excited to, well, as a lab as a whole, we're very, very excited to work with Integrity. And hopefully there's partners in the room here today who will work with us to bring that capital in through the right structures, through the right mechanisms, and ones that work for your investment committees. So I'm conscious that we have a few minutes left, and I was wondering if anyone on the floor had any questions. I think there's a question over there, and one over there.
Hi, thank you for a good discussion. Agnieszka from Carbon Markets at Equino. I wanted to go back to a mention of IRR that was in the discussion. What I found is that, kind of carbon project development is quite an interesting area where obviously we do need some minimal IRR in order to scale this up, obviously, but at the same time there's almost like a ceiling on the IRR, which is in a way acceptable, because otherwise obviously if people start getting too much return on the projects, maybe that means they're not rewarding the communities enough, etc. Would you agree with that? If so, do you think there is a bracket of IRR that should be acceptable, and maybe what would that be?
Thanks for that question. Great. I can start if you were, yeah.
Go ahead.
Yes, so no, I think it's a very fair question, and again, I think where we see the challenges, and again, just coming back to the early stage development, that's really high risk. So not blaming private capital seeking a really high return. Our problem with that is that it's just not the right, or it might compromise the project. But once we have at the SPV level, as Karin explained, then you have already the revenue stream. The whole model is clear. We believe, I personally believe that you might not be able to, or might not want to cap the IRR. What is key, and what we haven't seen in the past, or we have seen a misuse of, if the price goes up, I think that has to plateau, but you don't necessarily have to cap. It's all a balance, right? So risk-return balance. So and the contractual framework is critical. When we talk about the revenue share, benefit share, and we're gonna work on a framework and put it out to the market as well in the coming months. it is also depending on what are the other contractual terms. Do you provide some collateral? Do you provide, so where is that risk return? So if you provide some risk mitigation, maybe you cap that, maybe you need to you can cap it. If it's more risk, maybe you don't. But the point is, it has to be very balanced. And if the price goes up, the majority should stay in and should go there. And I can tell you very openly where we are calibrating the IRRs and where we believe is the threshold for investors. And very happy to take different opinions from the room, but we believe that the 15-20% IRR should be possible to achieve on a long term. Of course, it again doesn't mean anything because it depends on what's your views on the carbon price. So it is quite circular. We believe that in a relatively conservative price scenario that should be achievable, and definitely if price goes much up, there is some more upside there, and the project has to also work maybe in a more bearish scenario. So we also build in resiliency, and I think yesterday in the discussions we also had some people. I remember one of the panels mentioning profit share, thinking about not just revenue share, taking our top line revenue is very very heavy for a project. So also thinking about what financial instruments, depending on the project, again, multiple revenue streams or carbon, and making it a fair scheme for all stakeholders. So that's what I would say.
Yeah, I think I'd add to that. I mean, it really depends at what level of the project you're looking at the IRR. So you're looking at the project IRR, and just like that, you know, what's above the line in terms of expenses, and what's below the line in terms of profit sharing. And so a lot of the time in the community space, are the community members part of the core execution and delivery team, and they're actually viewed as an intrinsic part of delivering the project, getting paid to deliver the project, or are they actually just participating in a waterfall of net profit? Because that's going to look really different. Do you get access to cash first or at the end? Right? You know, and so we can make IRRs say a lot of different things. At the end of the day, you know, it's the investor IRR that's going to matter when it goes to the investment committee. But when you look at the project, let's look at all of the cash flows within the project, and let's understand what truly is cost or should be cost, and what truly is profit. And when we talk about fair benefit sharing, let's make sure that it's the community that is helping to sponsor this project that is getting the benefits that are coming from this project as well. And so I think that that's part of the risk analysis that we need to do to make sure that we're allocating risk and mitigants in the right places. And that will help to identify how the IRRs are calculated for the various participants in the capital stack.
There's one more question over there.
Hi, Sam Lampert with Morova. Thank you. First of all, the DevCo concept is essential in this space, and so I think it's wonderful that you're building it out alongside other companies are doing similar work, and I think it'll really help mature and allow us to deploy capital much more efficiently. I wanted to go back to, Karin, your point about way you partner with local developers on the ground. And maybe talk a little bit about how you build those relationships. And so it's not merely a bunch of Americans and Europeans coming in and saying, this is how you should do your project, but really allows them to kind of add their local knowledge and kind of find relative strengths and ways of participating in the project.
Yep. Yeah, absolutely. It's interesting when we look across our pipeline, there are projects that we come into relatively early in the process, and it is an extremely slow or collaborative and deliberative process, and it's a lot of listening and really understanding what are you into? Why are we doing this? Why are you doing this? What do you have and what do you want to get out of it? We also have a fair number of projects coming into the pipeline that have, you know, a developer has already put a lot in place, and you know that's at a place where we can kind of say, all right, what agreements are already in place, and understanding how close they are to the ground. And so I think within our pipeline, there's a range of partners that we might look at, and that partner evaluation and partner KYC, if you will, is really critical. The closer we can get to the ground, we can really ensure the quality of the relationships and that the community is being heard and that the dynamic of the interactions and the explanations and the integration of community needs is being made in the scoping of the project. I think when we're kind of 2 steps removed working with the London or New York-based developer and they're working with a developer on the ground, then we've really got to go very deep into that KYC to make sure that, in working with them, that we've unpeeled the onion to see what's going on underneath that. And that's a lot of what we're doing is making sure that the community is being heard.
Yeah, no, that's a very good question, and so again, we are a small team, and we'll grow, and the idea is we're not going to be London and the US based only, so a decentralized model. We'll try to add colleagues obviously in the regions, primarily working in the global south, but might also work in Europe and more temperate climates. And then one of the key things where we see the need is also what Karin explained during the whole process of building the SPV, is that we definitely hire a local person there who is in our headcount to make sure that it's local, but also it gives you that oversight or that connection and bridge to the investor, which is often one of the biggest risk factor and ongoing, that you are too far away and you don't know really whether what you're receiving is fully true. So we try to build that in the model and create a more transparency and collaboration. But definitely our funding value again for us is collaboration and partnerships, and we don't want to do that from sitting in London and DC for sure.
Thanks. Thank you both. Oh, sorry. Go on. Apologies.
Can we have a last question?
One last question.
Okay, a quick one then. Martin
Be
Note,
conscious that you're between everyone and lunch.
very quick. Martin Note, Hinterland Management, thanks for your insight. A quick one. What is your view on integrating your nature-based projects, more like carbon-driven, into additional new opportunities, value drivers like sustainable biomass, cattle feed, so integrating more opportunities to de-risk your project, in line, I think, also with what David Brand said yesterday as his closing remarks. So what is your view on that? Just quickly, before lunch.
Just quickly, very, very much aligned. So we again, our team and experience comes from the nature-based side, and we conscious that we have to integrate the same way as, and I think we heard it throughout this conference, that the forestry sector and agriculture sector is conscious that they have to go to the other side, and I think that's what is exciting, that it's happening. A few years ago, I think we were still talking in silos, carbon people looking carbon, biodiversity people biodiversity even, so even within the environmental assets we were looking in silos, and definitely in the industry side. So we are definitely looking into, as we said, holistic landscape. Energy might be a bit too far, but definitely starting with the other revenue streams as well.
I'm an infrastructure person. I'm a sustainable infrastructure person. I've spent half my life doing built infrastructure and natural infrastructure, and so I think that the built world needs to understand the natural world and vice versa. At the landscape level, we may not be doing that as much, but I think we do need to understand how they fit together, and we need to be speaking the same language no matter what.
Thank you both. Super exciting, and I'm sure we could carry on, but also conscious that there are exciting propositions called lunch outside, so we'll stop there. These lovely ladies will all be outside, so if you want to know more, please do grab them during the lunch session, and thank you very much.